Steve kind of laid out what the market wants. Is it what the market needs, and is it what the market will get?
I think this is becoming less about Keynes and more about Pavlov. The market has been conditioned to demand a rate cut when it feels a little weak in the knees, and the Fed has been inclined to so grant. I think that there is an almost uncanny consensus that the Fed needs to be easier. And you can see it in the unlikely pair of Larry Summers and Donald Trump, which is about as unlikely a consensus as. But I think it's a very hard consensus, and I think it's based in some part on the shape of the yield curve, which is everyone's favorite datum now. And indeed, it looks as if the Fed were too tight. My question is, the Fed, take a longer view. We had a tech problem in 2001. The Fed accommodated that with a 1% funds rate in the hopes of levitating house prices to compensate for the decline in stock prices. They succeeded. In the wake of the mortgage difficulties of 2008, the Fed has given us approximately a decade worth of very concessionary monetary policy. And now there's, I think they're going to cut in June. But you wonder where it ends. At least I do.
June is in this week.
June or in July? You think they're going to cut tomorrow?
They're going to cut.
Yeah, I do. Yeah, Andrew just said that.
I said what he was going to say. Unfortunately, I was trying.
It was a very accurate prediction.
I didn't want to take too much away, but that's a big.
I thought that was almost misspeaking. I thought it was you thought they were going to cut in July.
I actually thought that was a mistake.
Yeah, I did too.
No. Well, it might be a mistake. We'll know Wednesday whether it was a mistake. But that's my view: is that they'll cut preemptively in June. That is to say, Wednesday.
Meaning that they'll cut once and hope to stem some of the concerns and be able to step back after that, or?
Well, I think that they're going to cut more than once this year and start in June. But certainly indicate.
But you think it's a mistake? You think it's going to feed the excesses in the market? And Jim, I'm not going to take the words out of your mouth, but when I was interviewing John Williams at the Council of Foreign Relations, I called on you for a question, and you asked a marvelous question.
Yes, and it's a question that's
teeing you up, sir.
Yeah. I said approximately that President Williams, given the well-known tendency of very low rates to incite speculation and the misallocation of resources, and given the well-observed tendency of the Fed to intervene to quash difficulties in the market, is not the Fed now operating on the de facto dual mandate of arsonist and fireman? And he said,
I bet he said no. Right?
Look, I mean, there's an experiment going on. The experiment now is, we messed up before the financial crisis by not supervising markets. We've now been given that power, so we're going to run monetary policy and bank supervision on a separate track. And they've come up with this fancy word called macroprudential supervision, and nobody knows if it's going to work.
Well, no matter how many syllables you have doesn't mean it's going to.
I think it's inversely proportional to the effectiveness. Macroprudential.
Sorry,
I mean, Jim, speak though to the China situation, because to me that could change everything if you think a deal is had and what that ultimately does to the economy, or at least to the markets.
Yes, that a deal would be.
And how the Fed should be thinking about that one way or the other. How that should be in the calculus.
You wonder what monetary policy can do to something as real as trade. What the Fed could do by lowering its interest rate in the face of a non-deal is to give people the idea that rates will still go lower, and it is safer to buy securities that would be unsafe at a slightly higher rate of interest, which feeds the problem of misallocation and of speculation built on the Fed's well-intended concern for the economy as a whole.
Jim, do you think equity prices are too high here, given where interest rates stand right now, or?
I think that interest rates are too low. Certainly equity prices with respect to bond yields are not especially high, but nobody's getting paid a real rate of return as a bondholder the world over. I mean, the 10-year Treasury yields nothing after. I misspoke. In Argentina, you can get a 13% real return on an inflation-linked security. Steve, you writing this down?
I am. I'm just trying to do a risk assessment on that. That 13% may be underpaying me. Jim, before we go, I want to ask you about the pressure that the Fed gets politically now. With the president making comments about the Federal Reserve, do you think that has an influence at all inside the room?
I think that the White House is getting inside the head of the Federal Reserve. And I think these comments, to a degree, are warranted. I think the Fed ought not to be above politics. The Fed is a creature of the United States Congress. It ought to be answerable to the Congress, therefore to the government, therefore to the people. And I think to treat it as if it were some branch of the church would be the wrong approach. But I think that the comments coming from the White House are often brutal and rhetorically. And I'm not sure how, I mean, when candidate Trump in 2016 said that that thanks to the 0% rates, that there's a false economy and a false stock market. And just because he got a new speechwriter doesn't mean he was wrong. I think that...
Wrong originally, you mean?
Yeah.